It is an honor and a pleasure to speak at the Global Investment Summit today. As you introduced, EquityNet and myself have been functioning in this space for quite a long time. We founded the platform over 15 years ago, which makes it literally the first crowdfunding platform launched in North America, actually before the word crowdfunding even existed. Just a little bit about EquityNet. Like I said, it's a 15-year-old platform. It's been used by thousands of companies. Up to date, over $600 million has been raised. It focuses on accredited investors and features over 25,000 accredited investors. The platform is backed by 5 granted patents and features some very advanced technology that's been developed over the years. I was asked to speak a little bit about the industry's background, given that I've been functioning in the industry for quite a while, and to give a little context about how much it has evolved throughout the years, and then of course touch upon where the industry may be headed in the future. What's really interesting is most people believe that crowdfunding began just maybe 4 or 5 years ago, and it actually was spawned well back in the late 90s in principle by the SEC, who at the time issued some no action letters in 97, 98 that allowed some rudimentary platforms to feature deals online so long as the investors were accredited and so long as they had to log into a private system in order to view those deals. And at the time, there were a handful of small platforms like V-Finance, Funding Post, Funding Universe, and those platforms existed up until around 2004 and 5, when a new wave of innovators such as EquityNet, AngelList, and AngelSoft, which is now called Gust, created some more advanced technology and platforms to better capitalize and offer a better experience for entrepreneurs and investors within this marketplace. And so what's really happened over time is 3 things have come together to create this industry, and that is, of course, the internet and the connectivity it enables between multiple parties, the e-marketplace business model and the technologies that underlie all these platforms, and then lastly, the deregulation that has occurred incrementally beginning way back in 97, 98. Now, of course, the significant change in the regulations occurred with the advent of the Jobs Act, which was signed into law in 2012. And the Jobs Act featured a series of what's called titles. And each one of those titles were implemented over time since 2012. In 2013, what's called Title II was implemented, and that allowed for the first time general solicitation to occur, meaning companies could openly advertise their need for funding in the open world, not behind a closed password-based firewall. In 2015, what's called Title IV was implemented, and that allowed what's called Reg A+, and that allowed companies to raise up to 50 million at the time from non-accredited investors. That has since been up to 75 million. And then lastly, in 2016, what's called Title III, or Regulation CF, Regulation Crowdfunding, was implemented, and it originally limited the companies to $1 million. Now that has been increased to a $5 million limit. So there has been a series of incremental steps towards deregulating this industry. And as that has occurred, there's been a series of phases or waves of companies that have launched to innovate within the industry, whether it be going way back to Funding Universe, and then EquityNet, and then more recently companies like just presented Republic or WeFunder. And so the industry has become quite large, quite segmented in terms of the various business models and the ways in which companies can use these platforms to raise capital. There are probably, you can think of it as two main types of platforms. There are platforms that charge commissions, and those would be like WeFunder, Republic, and Start Engine. And then there are other platforms on the other side of that marketplace that are flat fee, such as Crowdfunder, Fundable, and EquityNet. And so, and those are all focused largely upon equity capital. Of course, there's a whole nother space of platforms that are based upon debt financing, such as Cabbage and On Deck, Lending Club. There are dozens and dozens of platforms out there that have different types of offerings and different types of pricing models and even different types of investors. But back to EquityNet, we are a flat fee based platform. We don't charge commissions. It is a simple month-to-month subscription. We have at this point been used by over 10,000 companies. We have over 25,000 accredited investors in our closed private network that can be viewed and accessed by entrepreneurs. And the company is used in this manner to raise capital for all types of exemptions, for Reg D exemptions, for Reg A, and even Reg CF companies that are listing primarily upon something like Republic can relist and re-advertise, call it, on EquityNet. So we're a very diverse platform in our business model and our ability for companies of varying maturities, using different exemptions for their funding rounds, to use EquityNet. And I thought I would offer just a few details about the types of companies that are using crowdfunding. Because given that EquityNet has been used by thousands of companies, when we've been fortunate in accumulating a very large amount of statistical data that characterizes, the types of companies that use crowdfunding. And so, for example, when you look at EquityNet and you look at the types of companies, you see that companies are seeking anywhere from $1 to $4 million on average. That they are that the amount of capital being sought has been around $2 million has been the typical funding round, but over the past 5 years that has trended up to more of around $2.5 million. Surprising to some people, the average age of the companies that use EquityNet are around 4 to 8 years old. Of course, we do have lots of startups, but we do have some relatively mature companies that use the platform, again, ranging from 4 to 8 years old. In terms of our investors and what they find the most interest when you look at the statistics on thousands of companies, and all of this information is available on our blog or in the footer of EquityNet, called an area called Funding Statistics, all free data to look at. But lately we did an analysis and found that of the top 10 industry sectors, Software was the most popular, followed by business product and services, followed by consumer products, biotechnology, real estate, healthcare, and so on. Another interesting set of data that we found on companies that are using crowdfunding, and given that EquityNet is used by thousands of companies, this data I'm referring to is very representative of the entire industry, given the sample size. But nonetheless, the average valuation of companies has trended up over time, more or less in line with the stock market. And whereas it used to be that companies were raising funds at a valuation multiple of around 5 times revenue, that trended up to about 10, and lately has been closer to 11 to 10 times revenue. That is the valuation that they are using for their funding rounds. And those revenue multiples vary by industry, with media and entertainment having the highest average relative valuations, followed by software, business product and services, and biotech. So there is a lot of data available at EquityNet, given our history and our thousands of data points that we've accumulated for companies to come and to learn about, what their peers look like and how they're using crowdfunding in general at EquityNet. Again, there are 2 types of platforms, and the one type of platform that is most predominant is, of course, a commission-based, and those are largely in the Reg CF space. Some of them also handle Reg D offerings, and those typically involve, quite a bit of due diligence and compliance costs in order to prepare those funding rounds, and timing involved. So the cost and timing is relatively high in order to accommodate the regulations that allow those platforms to charge, a 6, 7, 8% commission of funds raised. And so a large distinction to that for EquityNet is that we are flat fee based, and therefore it is not incumbent upon the companies to comply with those extra regulations for that commission model. Of course, they must do their own legal work for their offering memorandums and their funding rounds. But the use of EquityNet is relatively simple and straightforward, because we have spent millions of dollars and years developing a highly automated, very advanced technological platform that allows us to charge a very low price point and low fixed monthly rate for companies to use EquityNet. So we have 2 primary modes of use. We have a DIY option for companies to use the platform on their own, and they have a wide range of tools that they can use to build a business profile and a business plan, and analyze that, to review investors, to engage those investors, to share or upload and share documents, to communicate with those investors, to even track the activity on a daily basis with those investors. We also offer a full service offering, where we have an expert team of consultants that work with companies to effectively collaborate with them and run their funding campaign with and for them, using all of these tools in a very efficient manner, again, with a relatively low price point, because we have streamlined so many of the manual processes that our peers do by hand with advanced patented technology. And of course, if you'd like to view any of our patents, they are all listed in the footer of our website. Now, I'd like to open up for any questions that may exist.
There are several questions, and we do have time to take about 2 or 3. I'll just read some of them out loud to you, Judd, if that's okay.
Certainly.
All right. The first question is, can you share with us where do you see the future of crowd equity? Is it something that you're going to see change during this pandemic? So I guess there's a pandemic question in there.
You know, I have a very interesting answer to that. When you look at the number of business creations, the number of business formations, in the last Great Recession of 08-09, the number of business formations in the U.S., according to the BLS, Bureau of Labor Statistics, and Babson College, who put out what's called a Global Entrepreneurship Monitor, the number of those companies actually went up, surprisingly. And guess what? When you look at the data trends in this recent recession, the number of business formations registered in this country actually also went up during the recession. So it's actually counter-cyclical that companies, people actually seek to, create their own company during periods of recessionary downturns. So that's on the business side. On the investor side, we have not seen really any downturn in investor activity. And I guess you could probably just look at the stock market to see how investors are, on a risk-on mode in terms of their desire to invest not only in public securities, but also in private securities vis-a-vis our platform and our peers' platform.
Last question coming in here from Anna. Is it difficult to manage a crowd equity platform? It seems that it's not something that they see too often within their ecosystem.
The operation and management of a platform is very particular. All of our platforms are what's called a two-sided marketplace. We bring together two sides of the marketplace, investors and entrepreneurs in our case. You could look at, other sites that bring together multiple sides, but that's very different than a business model that is, a website selling, say, retail items to a one-sided market. So yes, it is a greater challenge to run a marketplace within a two-sided market because you have to have operations and capabilities that satisfy your investors and your entrepreneurs. And sometimes their needs and desires are not always equivalent. So it does take a lot of experience and a lot of know-how and adaptation and evolution and learning to create a construct that, tries to make everyone as happy as possible in the experience.
Last question here, Judd, and this is mainly coming from the team because we're really excited to have you. You have definitely pioneered this space. I guess our question for you is, where do you see the future of crowd equity going, and how would you want it to be remembered by when it comes to pioneering this space? And thank you again.
Sure. Foremost, I think the volumes of transactions will continue to grow, both based on most of the data I've seen. The annual growth rate in our industry has continued unabated to be, 50 to 100% year over year for like a decade now. So it's a hyper growth industry, and there's actually a few industries that maintain that type of growth for that long a period. And I don't see any paring back or limitation in that growth. The fact is, 20 years ago when this industry got started, there was a massive amount of companies, millions of companies in the US starving for capital, and trillions of dollars held by wealthy individuals, and there was a bottleneck in between that they could not get to each other. And so we have opened up the door for those two parties to transact with each other directly and not necessarily through venture capitalists or other managed intermediaries. And there certainly is much more market potential than has even been engendered thus far. So not only will the growth in transactions continue in volume and activity and number of participants, but I also think the industry will mature in its capabilities. You may see things like more fund type options where investors don't have to choose individual investments, but they can pool their money with others into a mutual fund type principle where their money is spread across a number of companies in, say, a biotech fund or a software fund. I think you will see, further segmentation in the industry by platforms, each carving out its own niche area. And you'll probably also see some advancement and creation of secondary markets where these shares bought by investors and owned by founders and staff members can be possibly listed and sold to others, much in the way you see in the public markets. And that would be tremendous for improving the liquidity of the industry and the exit ability of people who make investments into these privately held companies.